Have you ever seen a company announce a stock split and then watch its stock price just take off? Even when all the experts are saying, hey, nothing's actually changed. Well, today we're going to pull back the curtain on that whole mystery. We're diving deep into stock splits and their close cousin, bonus issues, to figure out what is really going on behind the scenes.
The official textbook definition calls these things cosmetic changes. They say it doesn't change the company's total value at all. It's kind of like trading a $10 bill for two fives. You've got more pieces of paper, but the value in your wallet is exactly the same. But if it's really just a cosmetic change, then why on earth do companies even bother? And, more importantly, why do investors and the whole market sometimes go nuts for it, sending the stock price soaring just on the news? That's the real question, isn't it? Well, the answers aren't going to be in the flashy headlines. Nope. They're tucked away in the accounting ledgers. They're buried deep in the tax code, and they're hidden in the subtle, unspoken messages that the boardroom sends out to the market. So let's get our decoders out and get to work.
Okay, first things first, we have to get our heads around the fundamental difference between these two things. And honestly, the best way to think about it is with a simple analogy. Are we just slicing the same pie into more pieces, or are we actually baking a whole new pie with ingredients we already had stored in the pantry?
So a stock split, it's exactly what it sounds like. It's just slicing the pie. The company takes every single existing share and just chops it up into more units. So let's say you owned one share worth $100. A simple 2-for-1 split means you now have two shares, and each one is worth $50. The total value of your investment? It's still $100. Nothing's really changed. But a bonus issue, now that's a different beast altogether. With a bonus issue, the company hands out brand new shares to its shareholders completely free of charge. But wait a minute, where do these free shares come from? Well, they're funded by taking the company's accumulated profits, its savings or reserves, and turning them into share capital. This is the key. The company is taking past profits that could have been paid out as cash dividends and is instead converting them into permanent shares. It's not just slicing the pie, it's using its stored ingredients to actually bake a new one. And this difference? It becomes crystal clear when you pop the hood and look inside the accounting engine. It really boils down to a story of a simple little memo versus a real actual movement of money.
This table breaks it all down beautifully. Just look at that first line, face value. That's the nominal, on-paper value of one share. A split cuts it down, right? But a bonus issue, it leaves it completely unchanged. Now look at the balance sheet row. A split is just a shuffle, but a bonus issue, that's funded directly from the company's past profits. And that leads to the most important line here. Share capital doesn't change a bit in a split, but it actually increases in a bonus issue. That's a huge difference. So to put it as simply as possible, a stock split is really just an administrative task. It's paperwork. No actual funds move from one account to another. The accountants just make a little note, a memorandum entry, saying, hey, we've got more shares now, and their face value is lower. It's no different than you exchanging a $20 bill for two tens.
A bonus issue, though, that is a substantive, real-deal accounting transaction. The company makes an actual journal entry to permanently move money from its retained earnings account over to its share capital account. And that sends a powerful signal. It's the company telling the world, these profits, we're not paying them out, we're locking them into the very foundation of this business for good. Okay, everyone, lean in for this part, because this is where it gets very, very real for you as an investor. Those free shares that sound so fantastic, well, they might just come with a nasty little tax trap that you absolutely need to understand. In some places, like India, for example, the official cost of acquisition, what the government says you paid for those bonus shares, is exactly this: zero. A big, fat nothing. So, why is a $0 cost basis such a massive deal? Because when you eventually decide to sell those shares, the tax authorities look at it and say, well, since you paid nothing for them, the entire sale price is pure profit. That means every single dollar you get from that sale is considered a taxable capital gain. Ouch. So let's put the tax implications side by side. With a stock split, it's pretty simple. Your original cost just gets spread out over the new shares, and your holding period is totally unchanged. But with a bonus issue, that cost basis can drop to zero. And this is critical, the holding period clock restarts on the very day you get those new shares. If you sell them too soon, you could get slapped with a much higher short-term capital gains tax.
So, okay, if the accounting is so different and the tax implications are this tricky, why would a company's board choose one over the other? It's time to decode their playbook. It pretty much always comes down to one thing: signaling. Look, management knows a lot more about the company's future prospects than we do. By doing a split or a bonus, they're sending signals. They might be signaling confidence that future earnings will be strong enough to support the new share structure. They might be signaling that they think the stock is currently undervalued. Or, especially with a split, they might just want to lower the price per share to a more accessible psychological trading range to attract more everyday investors. And you can see just how calculated this all is by looking at this decision matrix. If the main goal is just to increase liquidity, make the stock easier to trade for smaller investors, a stock split is the go-to tool. But if the goal is to reward shareholders without spending cash, while also signaling that profits are being permanently reinvested for growth, then a bonus issue is the much smarter play. And then you have the reverse split, which is what a company in trouble might use to boost its share price and avoid getting kicked off the stock exchange. Every action has a very specific purpose. And all of this brings us right to the core lesson, the mark of a truly intelligent investor. It's about learning to look past the flashy headline of the announcement itself. You have to remember this. True, sustainable wealth is never created by the split or the bonus issue itself. That's just shuffling the same value around. Real value is created by the underlying performance of the business, the growing sales, the rising profits, the innovation that these corporate actions are supposed to be signaling. So, I want to leave you with a simple 3-step analysis checklist you can use from now on. The next time you see one of these announcements, just ask yourself these 3 questions. 1. The accounting. Was this just a memo, or was it a real conversion of capital? 2. The tax impact. What's my new cost basis going to be, and when does my holding period start? And 3, and this is the most important one, the signal. What is management really trying to tell me about the future of this company? When you start asking those questions, your whole perspective changes. You're no longer just a passive observer. So the next time a company announces a bonus issue or a stock split, I want you to ask yourself, are you just seeing a free gift, or are you seeing the signal?